In the late 1980s, Warren Buffett set his sights on Salomon Brothers, one of the leading investment banks of the era. Salomon Brothers had a stellar reputation for its prowess in bond trading and a rich history dating back to the early 20th century. Buffett was intrigued by the company's potential for growth and profitability. He saw value in its strong position in the bond market and its potential to capitalize on the booming financial services industry. In 1987, Buffett's investment company, Berkshire Hathaway, made a $700 million investment in Salomon Brothers preferred stock, giving Berkshire a significant stake in the company. This investment marked a new chapter in the history of both Salomon Brothers and Berkshire Hathaway. It was also the beginning of a roller coaster ride filled with ups and downs, triumphs, and setbacks. Part 1. The Treasury bond scandal at Salomon Brothers and Buffett's decision to intervene. In 1991, Salomon Brothers was embroiled in a Treasury bond scandal that threatened the future of the firm. The scandal involved the firm's traders submitting unauthorized bids to purchase government securities in excess of what was allowed under the Treasury auction rules. These actions effectively cornered the market for certain Treasury bonds, which ultimately led to a significant fallout, including investigations by the Department of Justice and the Securities and Exchange Commission, SEC. As the largest shareholder of Salomon Brothers, Warren Buffett was faced with a critical decision. He could either distance himself from the company, attempting to minimize any potential reputational damage, or step in and take action to address the situation head-on. Buffett chose the latter course, believing it was his responsibility to help the firm navigate through the crisis. In August 1991, Buffett became the interim chairman and CEO of Salomon Brothers, replacing John Gutfreund, who had resigned in the wake of the scandal. Buffett's decision to intervene and assume leadership was a bold move, as it exposed him to significant reputational risk if the firm were to collapse. However, he was adamant about restoring the firm's reputation and ensuring that the employees and shareholders were protected. Buffett implemented a series of measures to address the issues that had led to the scandal. He began by cooperating fully with the regulatory authorities, ensuring that all relevant information was provided and that the firm was transparent in its actions. Buffett also restructured Salomon Brothers' management team, replacing key executives and reinforcing the importance of ethical behavior and corporate governance. During his tenure as interim chairman and CEO, Buffett testified before the United States Congress, apologizing for the firm's transgressions and pledging to implement strict controls to prevent similar misconduct in the future. His candid and humble approach was well received by both the government and the public, helping to rebuild trust in the beleaguered firm. Buffett's intervention at Salomon Brothers proved to be a turning point for the company. The measures he implemented helped to restore the firm's reputation and prevent it from collapsing under the weight of the scandal. In 1992, Buffett stepped down as interim chairman and CEO, handing over the reins to new leadership who would continue the work of rebuilding the company. The Treasury bond scandal at Salomon Brothers and Buffett's decision to intervene demonstrated the power of strong leadership and the importance of ethical business practices. Buffett's actions during this tumultuous period not only saved the firm from potential ruin, but also reinforced the principles that have guided his investment philosophy throughout his career. His willingness to tackle the crisis head-on, and his commitment to transparency and corporate governance served as a crucial lesson for both Salomon Brothers and the broader financial industry. If you found value in this video, please like and subscribe for more. Also, please join me on Patreon for daily stock ideas. Now back to the video. Part 2. Buffett's management changes and efforts to restore Salomon Brothers' reputation. After stepping in as interim chairman and CEO of Salomon Brothers, Warren Buffett was determined to restore the firm's reputation and regain the trust of investors, employees, and regulators. Recognizing that the company's culture and management structure had contributed to the Treasury bond scandal, Buffett set about implementing changes that would promote transparency, accountability, and ethical behavior. One of the first steps Buffett took was to replace key executives who had been involved in or connected to the scandal. He appointed Derek Maughan, a respected Salomon Brothers executive, as the new CEO. Maughan would play a pivotal role in rebuilding the firm and implementing the changes that Buffett envisioned. Buffett also brought in a new general counsel, Robert Denham, who helped navigate the legal challenges the firm faced during this period. Buffett focused on fostering a culture of openness and honesty within Salomon Brothers, stressing the importance of ethical behavior and corporate governance. He established new policies and procedures to ensure that employees at all levels of the organization were held accountable for their actions, and he encouraged open communication to prevent misconduct from going unnoticed. One significant change Buffett implemented was the creation of an ethics hotline, allowing employees to report potential wrongdoing without fear of retribution. This simple but effective measure helped to foster a culture of accountability and transparency, making it more difficult for misconduct to go undetected. Buffett's efforts to restore Salomon Brothers' reputation extended beyond the firm's internal operations. He sought to rebuild trust with investors, regulators, and the public by being open and transparent about the company's actions during the scandal and the steps taken to address the issue. His appearances before Congress and in the media helped to convey the message that the company was taking the scandal seriously and was committed to making amends. Under Buffett's leadership, Salomon Brothers began to regain its footing in the financial world. The company's cooperation with regulators and the implementation of new policies and procedures helped to avoid further sanctions and penalties, while the change in leadership and culture signaled a commitment to ethical business practices. Buffett's management changes and efforts to restore Salomon Brothers' reputation demonstrated his ability to navigate a complex and high-stakes situation, leveraging his experience and reputation to bring about meaningful change. By instilling a culture of accountability, transparency, and ethical behavior, Buffett not only saved the firm from potential collapse but also left a lasting impact on its future operations. Part 3. Salomon Brothers' recovery and eventual merger with Travelers Group. Thanks to Buffett's intervention and leadership, Salomon Brothers slowly began to recover from the Treasury bond scandal. The company managed to avoid severe legal consequences and gradually rebuilt its business. In 1997, Salomon Brothers merged with Travelers Group, a major financial services firm. The combined entity would later become part of Citigroup, one of the world's largest banks. Part 4. The financial outcome for Warren Buffett and lessons learned from the investment. While the Salomon Brothers investment was a tumultuous chapter in Buffett's investing career, it ultimately proved to be a profitable one. Berkshire Hathaway's initial $700 million investment in Salomon Brothers preferred stock ultimately grew in value, thanks in part to the company's recovery and eventual merger with Travelers Group. Although the exact financial outcome is difficult to pinpoint, Buffett was able to exit the investment with a profit, further solidifying his reputation as a legendary investor. From his experience with Salomon Brothers, Warren Buffett learned valuable lessons about the importance of corporate governance, ethical behavior, and the power of reputation. The Treasury bond scandal highlighted the consequences of a toxic corporate culture and lax oversight, showing Buffett that even a successful and well-established firm could face collapse if its values and management were compromised. As a result, he became an even stronger advocate for transparency, accountability, and strong ethical foundations within companies. Ultimately, Buffett's involvement in Salomon Brothers reinforced his belief in the importance of strong leadership, integrity, and good governance as essential elements of a successful and sustainable business. The lessons learned from this investment continue to shape Buffett's investment philosophy and have left an indelible mark on his storied career. Thank you so much for watching.